Welcome to this quick how to tackle guide. In our video today, we'll be looking at a calculation that often catches people out, which is traded exchange rate futures. We'll use an example to guide you through the steps and show you some of the pitfalls you might fall into when you're trying to pull one of these calculations together. So either grab a pen and paper and follow along, or just watch as we talk you through how to deal with these tricky calculations. So let's start with our scenario. This is the sort of information you'd see on the day in an exam, or the information you need to gather in the real world. Today is the 30th of June. Our UK-based company has a net payment due on the 30th of September of $4 million, so in 3 months' time. The spot rate of exchange today, dollars to pounds, is 130.78 to 130.80. September currency futures have a contract size of £62,500 and they're currently trading at 130.96. Okay, so that's the rate that they are currently buying or selling at. And if we use those currency futures, that's the rate where essentially we'll be trying to fix our exchange rate for this future transaction at. What will our net sterling payment be on the 30th of September if we hedge using traded currency futures? Assume in 3 months' time, on the 30th of September, when we do the transaction, that the exchange rate is 131.67 to 131.75, and that the futures price has moved to 131.71. So, plenty of information to be starting with, and it's easy to feel a bit daunted by all these figures and rates and dates. But if we tackle this logically and follow the steps, we can get it to work. The first big step is to set up the hedge. Now, there are 4 things that you need to identify and note down before you start the calculation of the hedge itself. First up, you need to decide if you're going to buy or sell. When hedging with futures, we need to buy or sell them today, the date you decide to do the hedging. So in this case, June the 30th, to start the hedge off. But the question is, do we need to buy them on the 30th of June to start this off, or do we need to sell them on the 30th of June? The answer is futures transactions always flow in the same direction as the underlying transaction that we are hedging. Now, our futures are in sterling. We know this because the contract size is quoted as £62,500. So we need to decide what we're doing to sterling in the transaction that we're trying to hedge. In this case, we're going to be paying $4 million on the 30th of September. Now, we're a UK company. We don't have dollars. So in order to accomplish this payment, we're going to need to buy the dollars from the bank that we need. And that means we'll be selling sterling to the bank to get that money. So the underlying transaction, we are going to be selling sterling in. So it means that we need to sell futures today, sterling futures, in order to start the hedge off. Next up, we need to decide what date of futures we need. Now, in some cases, you're going to be given lots of different possible futures dates. The rule is we always choose the futures with a date nearest after the date of our transaction. In this case, we're trying to hedge a transaction on September the 30th. So we would need September futures contracts. Now, as it turns out in this scenario, these are the only ones we have available anyway, so that's nice and straightforward. Thirdly, we need to identify the current futures price. So this is what the futures will be bought or sold at today to start the transaction going. This is actually, again, currently given to us in our scenario here. It's currently trading at 130.96. Finally, remember that futures are for standardized amounts of money. So we're going to have to work out how many of them we need to cover our transaction. Now, annoyingly, our transaction is in dollars, but the futures are in contract sizes of £62,500, a different currency. So in order to figure out the number of contracts, we need to do it in a couple of different stages. First up, take the transaction that we are trying to cover. So in this case, the $4 million, and translate that into sterling. The way we do that is we use the exchange rate that you've just identified as the current futures price. So take the $4 million and divide it by that 130.96. Now that the 4 million's been converted into sterling, we can divide that by the futures contract size, which is also in sterling, and that will give us the right number of contracts to cover the transaction. Now, unfortunately, it's not a perfect figure. You will probably get a string of decimal places after your answer when you work out the number of contracts. But remember, futures contracts aren't divisible, so you have to round to the nearest whole contract. So in this case, it's going to give us 49 contracts. And for setup, that's it. 4 things you need to work out before you get started on the hedge itself. It might seem like a lot of work for a first step, but it makes it easy to then sort out the hedge itself. So now we can actually do the hedging transaction. Again, there's quite a rigid set of steps for success. First of all, I just want to point out something about our exchange rates on the day of the transaction, so in September. I've put them from the scenario up here at the top of the screen. Now, you'll notice that the exchange rate doesn't match the futures price. In a perfect world, the relevant exchange rate and the futures price on the same date would be the same as each other. But as you can see, there's a mismatch. This is down to market imperfections and is called basis risk. It's not a massive problem. It just means your hedge probably isn't going to be perfect. We'll be close to a perfect hedge, but we won't be quite there because of this market imperfection. Bearing that in mind, let's undertake the transaction. So let's do the hedging. Now remember, all the exchanging is happening at the 30th of September, so watch the exchange rates that you're using. First up, we have our $4 million that we have to pay. So we have to go out and buy $4 million on the open market at whatever the prevailing exchange rate is on the 30th of September. Remember, the exchange rate future is a totally separate transaction. So we have to convert the $4 million for our transaction using the normal exchange rate on the 30th of September as if we'd done no hedging at all. Now, we've got that at the top of the screen already. The exchange rate on the 30th of September is 131.67 to 131.75. So we've got 2 possible exchange rates to use here. The question is, which of them do we use? Which is the right one? Now remember that the bank buys the foreign currency high and it sells it low. It's selling us the dollars we need, so it sells low. Another way to think about this is it's going to divide by the lowest possible number, so it charges us as much as physically possible for those $4 million. So we're going to use the low exchange rate on the 30th of September, which gives us a sterling cost of £3,037,898. The futures transaction is then a completely separate transaction to that one. And we usually do this looking initially at just one future. Now, think back to the information that we collected when we did our setup on the last slide. We said that to start the hedge off, we were going to sell futures today, 30th of June, so the date we decided to hedge. And we also said that the current futures price when we did that was 130.96. That gives us our first line. So we're going to sell on the 30th of June our futures each for 130.96. What we then need to do on the date of the transaction, so on the 30th of September, we have to do the exact opposite. We have to close the hedge out. So if we sold it on the 30th of June, we have to buy it back in September. If we bought it on the 30th of June, we'd sell it on the 30th of September. Okay? So we're going to buy it back on the 30th of September for whatever that future is trading at on that date, which again, at the top of the page, we've got the information there. The futures price on the 30th of September was 131.71. So that's the price we'll buy each of them back for. And that gives us our second line. The difference between those two lines, the sell and the buy line, is going to give us our profit or loss per pound hedged. So in this case, we have a loss of 0.75 cents, watch your decimal places, per pound hedged. Now that's great, but that is per future. We need to figure out what the total loss is that we made on the futures transaction. So we're going to have to multiply this up. And the way that we do that is we take the loss that we just identified, so the $0.0075, and we multiply it by the number of contracts, which we worked out in our planning phase, which is 49. And we multiply by the standard contract size in sterling, which was £62,500. Now, that will give you initially the total loss on the futures. But annoyingly, it gives you the loss in dollars. It gives you it in the wrong currency. So if we were to just do that first little bit of the calculation, we would end up having made a loss on the futures of about $22,969 when we close them out on the 30th of September. Now, unfortunately, like we said, we need that number in sterling. So we'd need to find that $22,969 in sterling to cover the loss. Now, again, we're a UK company. We do not hold any dollars. So we would need to buy those dollars so we could pay off that loss. So we'll buy the dollars from the bank on the 30th of September. Remember, the bank sells us dollars at the low rate. So in this case, we'd actually use again that 131.67 rate like we did for the main transaction. If we'd made a gain on the futures, we'd have taken that dollar gain and sold it back to the bank, who would then have bought those dollars from us, and it would have bought them off us at the high rate. But in this case, because it's a loss, we're going to use the low rate of exchange on the 30th of September. So that's going to let us calculate our total loss on the futures in sterling, which is £17,444. If we adjust the original transaction for this amount, it'll give us our net position after hedging. So we've cleared our $4 million payment, and in total, it's cost us £3,055,342. Now, it's worth checking to see if this result was reasonable, because there's a lot that can have gone wrong with this transaction. So what we can do is we can work out the effective rate. So we've cleared our $4 million. We've paid off $4 million, and that has cost us in sterling after the hedging £3,055,342. So if you take your dollars and you divide them by the sterling amount, you'll get the effective exchange rate that you've achieved, which in this case is 130.92. Now have a look back at the original futures price that we sold at, which was 130.96. Now that was what we were trying to fix our exchange rate at. Whatever we did that kind of initial futures valuation of, so that 130.96, that was what we were trying to fix the exchange at. And we've only got 130.92. So we were close, but we weren't quite there. So the question is, why? Why were we not quite there? Well, there are a couple of reasons. Partly it's due to that basis risk that we talked about before. So the actual market price of the futures wasn't quite right because of market imperfections, and that's kind of screwed up the calculations a little bit. It's also partly because we had to round the number of contracts, so that can lead to a little bit of over or under hedging. But overall, our hedge using exchange rate futures has got us most of the way towards fixing our exchange rate and reducing our exposure to fluctuations in the exchange markets. And that's it. It's a fiddly transaction, but in this How to Tackle guide, we've talked you through the key steps to give you, hopefully, a good chance of getting it right. See you next time.